And now we can see that gold has actually overtaken treasuries in central bank foreign exchange reserves. Think of foreign exchange reserves, by the way, as a bank's piggy bank, right? A reserve wallet where it keeps lots of different currencies. And this is exactly what Ray Dalio is describing in one of his latest interviews.
We're going to have a supply-demand problem for debt at the same time as we have these other problems.
Supply-demand problem for debt, meaning we have a lot more supply of our debt and not enough demand around the world to buy it. Instead, we could see that central banks have been buying gold pretty aggressively over the last few years. They're buying gold so that they could protect themselves against whatever system replaces this monetary experiment we're running. Now, in a more technical explanation, something called Basel III changed how banks value gold on their balance sheet as of last year, and now gold is considered a higher quality reserve asset, valued at the market price instead of a discounted price. Now, that doesn't mean gold replaces treasuries in the global plumbing system, but it does make gold a lot more attractive as a neutral reserve outside the dollar system. And as a result of the debasement, again, to us, to normal people, it looks like the price of assets goes up forever, right? That's the line in black. This is the MSCI index excluding the US and the same index including the US. And it looks like the stock market goes up all around the world. But if you look at both of the indexes as measured in gold instead of dollars, which is shown by the blue line, you'll see that the market has actually lost value in comparison to gold since the year 2000. Again, this is slightly cherry-picking data, but one could argue the last 20 years is a good enough example to prove the point. There's strong evidence of the fact that this has been accelerated by China and all the central banks buying tons of gold so they could build out this parallel system to the dollar instead of using only treasuries. What all of this means then is that the structural demand for dollars might not grow, gradually going down. That's what Ray Dalio is describing. Dollars are debt in the form of treasuries. And if the demand for them goes down, that means in the future, we might see a lot more inflation. Peter Schiff is someone that believes that's exactly what's going to happen.
But Peter, people's incomes are pretty solid. We're starting to see some real gains in productivity. So let's call it the coldest.
We're not seeing that, Liz. Unfortunately, the numbers are not accurate. They're highly skewed. They're going to be revised, and a lot of it is being influenced by inflation. Inflation is going to be much more pernicious over the next few years than it was when Biden was president. Unfortunately, that's what gold and silver are telling you. They are a warning.
So now that we hopefully understand the dollar is getting weaker in relative terms, and that this serves as a structural economic purpose to make the US more competitive, but that it could also bring about inflation, especially in the asset space, the next question is, who benefits the most from this kind of a transition? So let me sort of explain this through the lens of my last video using the 4 power players, starting with the financial industrial complex, aka transnational capital, money that transcends nations. Remember, this power comes from controlling the financial plumbing system. These are things like the debt markets, the stock markets, proxy votes, etc. What they want control over is the flow of capital. They do this how? With the 3 asset managers we mentioned in the last video that together manage more than $30 trillion. With that money, they use their clients' votes as proxies to influence the direction of a company and who gets hired to run them. And then, of course, there's the banks, which want
ECBDC,
central bank digital currencies. They want to stay relevant in this transition. Okay, but why would all these guys be fine with a weaker dollar? And they'd be fine because they don't measure their wealth in dollars. They measure it in ownership of real assets, real money, which might be things like stocks, real estate, infrastructure, energy, commodities, right? And when a currency gets weaker, those kinds of assets tend to rise in what are called nominal prices. Who it hurts are the people that rely on their job for income, and who it benefits are those with assets. Okay, second player are the sovereigns, aka the leaders of tier 1 nations, and that would be the people with access to nuclear weapons. Now, what they want is more control over their supply chains, their energy, production, and their people. And a slightly weaker currency helps rebalance trade in their favor because it makes domestic production, aka the stuff a country makes at home, cheaper to make, and therefore more competitive when they sell it overseas. So while a strong dollar benefits consumers when we go to buy stuff overseas, a weaker currency can benefit nations trying to rebuild their industries, and it reduces their dependency on the old model where they have to run deficits to fuel their growth. So a sovereign power like the United States could benefit from the weaker dollar. I know how insanely complicated this might sound, but I hope all of this makes a little bit of sense. Now, I should also mention there's a slightly deeper layer to all of this, and I don't like talking about it because it walks the fine line of conspiracy, but it's the layer that is the competition with China for as much control, especially over society, as possible. Right? That's the China model. This is where the third power player comes in. That's the tech industrial complex. As the old monetary order becomes less dominant, whoever controls the new systems of technology gets more influence, it gets more powerful. Now, in my last video, I saw a comment that someone asked that I think ties into this, which is, how do mass deportations benefit the financial industrial complex? It's a really great question. So I'll be very careful how I answer it, but I hope you can read between the lines. You see, throughout history, a lot of economic transitional periods coincided with new systems that are sold to us as protection, digital identity tools, financial tracking systems, and more centralized infrastructure. That's because uncertainty in markets, uncertainty in society, increases the demand and the need for systems to control this unrest. So let me just say this a little bit easier. When things get crazy around the world, technology is sold as the thing that will make us safer. Technology then becomes the solution that is offered to people during times of instability, and these technologies can change the architecture of society, for better or sometimes for worse. This is where digital IDs, social credit scores, car switches, all that stuff comes in.
Fed doesn't wait for pain to become obvious, right? That's not what they typically do. The Fed, they claim that they try to step in before it's obvious, because once everyone agrees that there's a problem, by then it's already too late. Okay, think about it like driving downhill, right? You don't wait until the car is flying out of control before you hit the brakes. You tap the brakes early so you don't crash later, right? A stable economy doesn't automatically mean a safe economy. It just means the Fed still has, hopefully, some time to control it, right? Given what they say about what they're supposed to do in our economy. Now, here's where I start side-eyeing some of our popular narrative that we hear out here. A lot of people talk like the Fed's job is to make life easier for everybody, lower our payments, boost up the stock market, keep everybody comfortable and happy. That's not the Fed's job. The Fed's job is to protect one thing, not you and not me. The Fed's job is to protect the system, right? Not protect our individual comfort levels. And sometimes protecting that system means letting people feel uncomfortable longer than we really want to feel uncomfortable. So discomfort is not a failure of the Fed's policy necessarily. That's not how they see it. A lot of times it's just the tool of what has to be used to get whatever they have to do done in order to protect that system. Now, let's question something almost everyone assumes is true. We're taught that lowering of the Fed funds rate is always a good thing. Cheaper loans, more spending for us out here as consumers, more growth to the economy. But here's the part nobody really likes to say out loud. Cheaper money can restart the same problem that the Fed just spent years trying to control, which is inflation. When money is cheap, people spend. And when people spend, demand goes up. And when demand goes up, prices go up. This is exactly what happened in 2022, right? Cheaper car loans. Guess what happens? People go out and rush to buy cars and prices go higher. Cheaper mortgages, right? Bidding wars come back when you're trying to buy a house. Cheaper credit, spending goes up. So when people say, oh, just cut the rates already, my question is always, cut the rates for what? For us to go out here and start spending a bunch of money and raise prices again? Because if inflation comes back, we're right back where we started, only worse. Now, let's talk about something else that's uncomfortable, but it's also real. This is not really about Trump. This would be true no matter who or what president is in office, right? The moment the Fed looks like it's taking orders from politicians, markets start questioning the Fed's independence. And once that trust starts to slip, which it's already started to slip, right? Inflation becomes harder to control. That's why when political pressure gets louder, the Fed often digs their heels in and becomes more cautious, right? The Fed may or may not be trying to prove their point, but their credibility to the American people is on the line, and it matters more than their popularity. See, the Fed doesn't care if we like them or not. They just care if we believe them. Right? The US dollar is not backed by gold anymore, folks. It's backed by trust, the trust of the American people and the trust of the people worldwide. And the Fed only works if the people believe it will do what it says it will do, when it says it will do it, and their policies, right? That's why the Fed doesn't just control interest rates. The Fed also manages expectations through its words that it communicates, right? Its tone, its consistency. The way the Fed communicates to the public is part of their credibility. See, if the Fed loses its credibility, their policy gets weaker. That's why the Fed is always very, very measured about what they say to the public. The Fed has to keep their credibility. And when they do that, their policies work with less force. Now, here's another thing most people sort of misunderstand or underestimate. Interest rates don't work overnight, right? They work slowly. Sometimes it may take a year or more to feel the full impact of whatever the Fed does in terms of its monetary policy. It's like steering a big ship, right? You turn the wheel now, but the ship really don't move right away. But once it does start turning, it just keeps turning. So when people demand instant results from a Fed policy, I always wonder to myself, do you really realize the Fed is still watching what past rate changes are doing and the effect they're having right now today? That's called lag time. The Fed may lower the interest rates today, but the effects don't happen in the economy for a year down the road. That happens, and we need to know that that happens. A quick change in the policy doesn't mean a quick change in how things look around us. Now, let's bring this back to real life, right? Everyday people like you and me. For people who work for a living, this kind of environment that we're in right now usually means that hiring is going to slow down, which it already has, right? Companies are always looking forward. Okay. So companies are going to get more and more careful about hiring and bringing on new people. Raises and bonuses, they all get smaller, and jumping from job to job becomes riskier for the average worker than it used to be. For people who have debt right now, it means borrowing stays a little more expensive longer than expected. Credit cards are going to hurt longer with those 21 and 22% interest rates. Variable rate loans, they're not going to give as fast a relief as people had hoped in terms of their interest rates going down. And for those of you out here who are savers, and this group of savers gets ignored sometimes when we're talking about the economy. But here's something different. For the first time in a long time, keeping cash doesn't mean really earning nothing. Money sitting in the right place right now could actually be earning some interest again, especially if you have your money in, say, a high yield savings account. Now, not fast money, not exciting money, but real money for doing very little. You can get a little return on that still, right? And for my investors out there, this is the kind of stock market that kind of feels boring. It's going sideways. It's not going up real big. It's not going down real big. It's just kind of taking its time, right? With minimal gains so far. Sort of uncomfortable, like nothing is really going on right now. Nothing big, one way or the other. That's usually when people mess up, because boredom in the stock market and in investing pushes people to force moves, take some unnecessary risk, right? That they don't really fully understand. So what do we actually do in moments like this as consumers, investors, employees? First, we stop waiting for relief. Waiting for rate cuts to feel safe usually means waiting too long, or waiting for rate cuts to make a move with what we want to do. Also, right now, we need to separate our money by purpose, okay? You need some safety money. You need some growth money. You need some opportunity money. You need to get your resume ready. You need to make sure you have your skills up, right? And then you need to make sure you have some diversification. You don't want to have everything sitting in one bucket, because when you have everything sitting in one bucket, that's more risk. And every headline you see feels dangerous.